seeing, broadly speaking, a sell-off in technology stocks. As far as XAI and SpaceX is concerned, there's a bit of a bubble in the AI sector. Elon Musk has bought, through SpaceX, he's bought AI Cursor for $60 billion, payable in stock. And Elon Musk has been granted $1 billion worth of restricted shares in SpaceX, conditional on establishing a Mars colony of 1 million people. Well, that'd be a tough target to get to. I don't know how you're going to get 1 million people onto Mars and living in a colony. So, but, hey, you never know. Maybe something to aim for. Interest rates were left unchanged last week by the Federal Reserve. They're at 3.5% to 3.75%. That was the June 17th meeting. The new chairman, Kevin Warsh, removed the language previously used about interest rate cuts. So the market is now expecting interest rate rises in 2026. The CPI, or Consumer Price Index, came in at 4.2%. UK base rate was left at 3.75%, and the ECB raised its rates by 0.25% to 2.25%. Gold sank last week and today. Let's have a quick look at gold. And the reason for that was linked to, there we are, silver. Let's go to gold. There we are. Gold is at $4,114. Down another $75 today, or 1.8%. And the reason gold is sinking is the expectations of higher interest rates. Higher interest rates make the cost of carrying gold or holding it higher, or put it another way, you're missing out on a higher interest rate if you're holding gold, because gold pays no interest. But of course, that can be compensated if the gold price rises. But people who are thinking in the very, very short term basically react to news like that. Like the expectation of higher interest rates, and that's pushing gold down for the time being. So gold is clearly in a bear market. A bear market is when stocks or anything has gone down by 20% from its peak. But having said that, 1 year ago, the gold price was $3,350. Now it's $4,115. So it's well up on a year on year. So if you bought it a year ago, you're not an unhappy bunny, except that perhaps you wish you'd sold it at the peak of 5,500. But it's well below the peak and well above the low point. But certainly we can't deny that it's on the way down at the moment. Silver also is the bear market. It's down more than 20% from the peak of around $125. It's currently $62.34, as we see on the chart in front of me. And the DXY, which is the measure of the US currency against a basket of other currencies, is at 101. There we are. Let's bring that up. That's the highest point this year. So the dollar is rising. It seems that people are happy with the deal, which has been worked out with Iran, perhaps. In other news, Turkey has sold nearly all of its US treasuries, and it's not because they don't like the USA, it's because they needed the money. They've also been selling gold, and they've been selling that to buy diesel oil, because the country's running out. It doesn't have any oil of its own, and there could be civil unrest if people can't get their hands on petrol and diesel. So to try and supply the market, they've been selling their sovereign reserves. Same thing might happen with Egypt and Pakistan. Now, let's look at the US-Iran agreement. So what have we got? We've got an undertaking that USA and Iran will negotiate on Iran's nuclear program. That's basically the same as before the war started, so nothing changed there. We've got an agreement that enrichment and nuclear needs of Iran will be discussed. Again, that's not new. It's the situation as it was before the war started. Then we've got a pledge by Iran not to acquire nuclear weapons. That's no different from the pledge they made before the war, which is the very pledge that the United States didn't believe. We've got an agreement that the Strait of Hormuz will be opened. That's the same as before the war started. The fighting has stopped. We've got a truce for 60 days at least. Well, that's good for both sides. And when I say the fighting has stopped, they're still shooting at each other, but ostensibly in the name of defense, let's say. But hopefully that'll die down and go away completely. So that's good for both parties. Iran has agreed to let back nuclear inspectors, which the last time the nuclear inspectors were there was about a year ago in 2025. So although it's different from immediately before the war when the inspectors couldn't go in, it's no different from last year. Iran is going to keep its uranium, which is basically the same as it was before, but they've agreed that they will dilute it, at least dilute the highly enriched uranium. So it seems that the United States has conceded on that particular point. That's a positive, I suppose, for Iran relative to where it might have ended up. Another win for Iran in this case is the oil sanctions against Iran have been removed. Now, it's hard to know the reason for that, but probably the reason is the world is running out of oil, and if countries like Egypt, Pakistan and Turkey are forced to sell their reserves, they'll be selling their US treasuries first to buy oil. So it's in everybody's interest, the United States' interest especially, that they can get their hands on oil, which is why they've lifted the sanctions on Iran's oil. So Iran can now sell its oil. The sanctions which existed before the US strike have been lifted. Good for Iran. Iran gets to keep its uranium, good for Iran. And there are discussions to say that if the discussions progress favorably, the sanctions will against Iran will be lifted, maybe, or discussed being lifted. But in the meantime, there's been some sort of deal, which I haven't got the full details of, but it seems Iran may use the seized money to buy certain US products.
So let's start with China, though, and the gold situation. And I think what this gold situation shows is that the Chinese public, the Chinese mentality and culture, they've been exposed to currency collapses much more recently than we have in the West. And they know what gold is, and even silver, because I think the name for bank in Chinese is silver. But anyway, Bloomberg reported yesterday China's gold imports surged to most in more than 2 years. China's monthly gold imports reached their highest in more than 2 years in May, showing the world's biggest buyers' appetite for bullion remained resilient as prices remained under pressure. And I like to differentiate demand for bullion and speculation in this highly speculative paper market that is not just the FX market where LBMA gold is traded and silver, but also the futures market. And these markets are there on purpose for the bankers to manipulate and control the price, because they don't really trade physical metal in those markets. They rarely ever take delivery. It's only when delivery is very heavy that they have problems. And that's why I always tell people that they need to get physical. Forget about ETFs, forget about futures. Of course, mining companies is a different story. You're buying a share in a company that is either exploring or either producing the metal. Imports were around 163 tons last month, the highest since March 2024, according to customs data released on Saturday. Volumes for the first 5 months of 2026 were about 692 tons. That's huge. And I think a lot of that is also the central bank, the People's Bank of China. Yeah, officially they're buying a few tons a month, but I'm sure a lot of those tons seep through into state-owned CCP institutions. Yeah, we've been told central banks have been buying about 1,000 tons a month since 2022. That's all world's major central banks. And here we have the Chinese on pace to buying like almost 1,500 tons a year. So I think it's highly significant, and it's not going to stop. And they don't care about the price. They care about having the physical insurance. And that's what I've been telling you for years. So that's up by 76% from a year earlier. Chinese demand for physical bullion bars as well as metal linked to gold accumulation plans have been among the main drivers of the surge, said Song Jiangzhen, a researcher at Guangzhou Southern Gold Market Academy. Accumulation plans refer to low barrier products that allow investors to buy gold incrementally. Well, they know about dollar cost averaging the Chinese. Gold prices have retreated by about a quarter from the record highs reached in January, weighed down by global inflation fears amid the war in the Middle East. That doesn't make sense, right? The more you fear inflation, the more you should have gold. But anyway, this is Bloomberg. A strong buy from Chinese consumers was a key catalyst for the January frenzy, and domestic demand has since moderated, but without a major slump. How can it have moderated if it's up 76% from last year? Doesn't make sense either, Bloomberg. China also started implementing a new import licensing regime for gold from June 1st, with certain banks facing fewer restrictions. But the change may have prompted some banks to use up their existing quotas before the new system began.